Welcome back to the Deep Dive. Today we have a stack of sources that, they feel like a high-stakes roadmap, showing exactly where money and policy are colliding.
Wait, really?
We're plunging into global markets, the fine print of U.S. regulation, and the race for the future of aviation.
That's absolutely right. The material is so broad, from macro policy in Tokyo that's moving mountains of capital to these tiny legislative details that could define the future of DeFi right here in the U.S.
So our mission today is to pull out those critical nuggets.
Exactly. We want to illuminate the trade-offs being made right now in crypto, in consumer credit, and in that intense aerospace competition.
Okay, let's lay it out. We'll structure this in 3 parts. First, we're tackling the regulatory battlegrounds in U.S. finance.
Right.
Specifically, the new legislation on crypto market structure and that very heated debate over capping credit card rates.
Then from there, we pivot. We'll look at global governance, the incredible surge of the Nikkei, get a health report from JP Chase, and then dig into a Supreme Court case that could really determine the Fed's independence.
And finally, we'll turn to the skies. We're going to look at the competition, the innovation, Boeing's big comeback against Airbus, and some radical new aircraft designs.
And I think the big takeaway for you, the listener, is to understand the boundaries being set in real time. We're talking access versus protection, innovation versus stability. These decisions are shaping the investment landscape for the next decade.
Let's start in that regulatory crucible. And there is no hotter place than the Digital Asset Market Clarity Act, or DAMSO.
Right. This is the bill trying to finally impose some kind of structure on the crypto space, splitting oversight between the SEC and the CFTC.
And within that structure, the legislation has some very specific, you could even say controversial, guardrails.
It does. Let's start with what hits users immediately. Title IV deals with stablecoin yield, and it includes a major prohibition.
Okay.
Issuers are barred from distributing passive yield back to token holders.
Wait, so if I'm just holding a stablecoin in my account, I can't earn interest on it?
That's right. The only rewards allowed have to be tied to some kind of activity like account opening incentives, cashback, or staking, where the token actually supports it.
But losing passive yield was a huge red line for the industry before. I remember that. So why would a major player like Coinbase back this now?
It seems they're prioritizing legal clarity. They want the bill to keep its momentum, and they see this as maybe the least unfavorable option to finally get a clear regulatory status, even if it means giving some ground to the banks.
That's a huge compromise. Okay, so moving to the nuts and bolts. Title I, commodity clarity. It's trying to clarify when a token shifts from a security to a commodity. How does it do that?
The SEC has 360 days to publish guidelines. But the real mechanism, and this is key, it shifts the burden of proof.
To who?
To the asset issuers. They have to submit written certifications to the SEC showing their token is no longer a security. And then the SEC has just 60 days to deny it.
So the clock is really ticking for the SEC on every single one.
It is.
But the sources also hammered home this one crucial point that the industry fought for. The law will not be applied ex post facto.
That's the industry's major win. No retroactive liability. It prevents a regulator from just dropping a hammer on years of past activity, which, has been causing enormous anxiety and litigation.
And DAMSA also wades into what actually makes DeFi, decentralized.
Title III. It's trying to establish a bright line test. A truly decentralized protocol has to run on an automated rule or algorithm, and critically, no single person or group can have custody or control.
And what if there is some human intervention?
Then it's deemed non-decentralized. And those protocols have to comply fully with the Securities Exchange Act of 1934 and the Bank Secrecy Act, the BSA.
So all the anti-money laundering frameworks?
Everything. Registration, disclosure, record keeping, it pulls them right into the traditional financial regulatory system.
That sounds like a powerful dragnet, but I saw this surprising nugget of pragmatism in there, didn't you? A carve-out for security councils.
Yes. This is so important. The bill acknowledges that, real-world systems get hacked. It allows these councils to use predefined, temporary, rules-based cybersecurity emergency measures without losing their decentralized status.
So it's a temporary, rules-based fix, not permanent human control.
Exactly. It's a very practical solution.
Now, on the operational side, DAMCA is also cracking down on those Bitcoin ATMs you see everywhere.
Yeah, the digital asset kiosks. They're now officially money transmitting businesses. So operators have to submit detailed lists addresses, what assets they support to the Treasury every 90 days.
And there's a limit for new customers, too.
A pretty stiff one, $3,500 in a 24-hour period. It's a big increase in oversight for that retail end of the ecosystem.
And finally, there's the creation of the Micro-Innovation Sandbox.
Right. The CFTC and SEC have to create this within a year, but it is very constrained. It's limited to only 20 projects a year, and the firms have to be tiny, no more than 25 employees or $10 million in revenue.
A very small, controlled experiment, then.
Very small. Jointly approved by both commissions.
Okay, tying this regulatory detail back to your wallet, let's switch to consumer credit. This is another massive policy battle. We've got this rare bipartisan alignment.
You really don't see this often.
No. Sanders, Hawley, AOC, even former President Trump, all pushing for a one-year 10% cap on credit card interest rates.
And with rates averaging over 20%, researchers say this could save Americans about $100 billion a year. It sounds like a slam dunk for working families.
It does. But the financial sector, J.P. Morgan, think tanks like the Progressive Policy Institute, they're strongly opposed. They're calling it a price control set way too low.
Yeah.
Why is 10% the wrong number?
Well, the data on risk is pretty clear. According to 2022 figures, only super prime borrowers, we're talking credit scores of 720 or higher, had an average rate below 10%. For everyone else, the rate has to be higher to reflect the higher risk of default.
So what's the real-world consequence then? If you're a consumer who needs that credit, what happens?
The consequence is that issuers would just dramatically cut access to credit for anyone with a less than perfect score.
The very people the cap is supposed to help.
Exactly. If banks can't price the risk, they just stop lending to that segment. And that doesn't make the need for credit disappear. It just pushes vulnerable people toward, predatory alternatives. Payday lenders charging 400% APR. Pawn shops.
So if price controls are off the table, what are the policy alternatives that groups like the PPI are pushing for?
They're focused on three things. First, better transparency, making disclosures actually readable. Second, boosting financial literacy. It's shocking that only 25 states require a personal finance course to graduate high school.
That is astounding.
It is. And third, expanding community development financial institutions, or CDFIs. These are often nonprofits that offer lower interest loans to communities that major banks often ignore.
Okay, from the risk on a credit card statement, let's zoom out to the global markets, starting with the just staggering performance of the Nikkei 225.
Absolutely staggering. A record close of 53,549. This is huge. It's a fundamental shift in how the world sees Japan from a value play to a primary growth engine.
And this surge is the result of what's been dubbed Sananomics.
Right. It's this really aggressive policy, a massive 135 billion stimulus package focused on technological sovereignty, plus a new AI Promotion Act. It's just successfully attracted huge amounts of foreign capital.
But it wasn't just stimulus money. There was also a major corporate cleanup act.
Correct. The Governance 2.0 update was the real catalyst. It basically forced Japanese corporations, who were famous for hoarding cash, something like 115 trillion of it,
Wow.
to aggressively return that value to shareholders through buybacks and dividends. That liquidity is what brought global fund managers rushing back in.
And who are the direct beneficiaries of this?
Well, domestically, you have the semiconductor and automation giants like Advantest and Tokyo Electron. But it's a global thing, too. Their U.S. counterparts, Intel and AMD, are also benefiting thanks to a huge commitment of $550 billion from Japanese firms for U.S.-based chip projects.
A very tight alignment then.
Eerie.
Now let's check in on U.S. banking health with J.P. Morgan Chase's Q4 earnings, a strong report. $13 billion in net income, 7% revenue growth. Looks pretty healthy.
It was strong, yeah, but the sources point to the cost of that growth. Expenses were up 5%, and there was a decline in their CET1 ratio.
Okay, for those of us not in banking, what is the CET1 ratio and why does that decline matter?
Think of it as the bank's core financial cushion. It's the highest quality capital that keeps it safe. A decline means that cushion has shrunk relative to its assets. And a big part of that was their acquisition of the Apple Card portfolio.
Which added how much?
A staggering $23 billion to their standardized risk-weighted assets, or RWA.
And RWA is the capital a bank has to hold against its loans. So that's a huge new number they have to account for.
Exactly. The more RWA you have, the bigger your cushion needs to be. As for the outlook, Jamie Dimon described the economy as pretty stagnant, with inflation still a big concern for 2026.
Shifting to governance, there's a huge showdown at the Supreme Court. Trump v. Cook. This is about the attempted removal of a Federal Reserve Governor, Lisa Cook.
And the core issue is the interpretation of that for-cause protection that's meant to keep the Fed independent from politics.
What's fascinating is the sheer weight of the Amici Curiae brief. the friends of the court, from former Republican officials.
They're arguing forcefully against allowing the removal. Their foundational argument is that it would upend a 225-year tradition of insulating the Fed and its predecessors from executive interference.
They called that independence the bedrock of global confidence.
They did, and they warned of profound instability if the president can just replace the entire board whenever they want. They're arguing the text of the law is designed specifically to prevent that kind of sudden, arbitrary executive control.
Got it. Okay, before we move to aerospace, one last piece of high-stakes domestic policy. The California wealth tax proposal.
This is the proposed 2026 Billionaire Tax Act. It's a one-time 5% excise tax on net worth over $1 billion.
And the goal is to raise $100 billion for healthcare and food assistance. But that sounds incredibly complex to actually implement.
It's massively complex. The main problem is valuation. How do you value these assets? It requires totally new, untested methods, like a book value plus earnings multiplier calculation. That complexity is why it's already facing stiff opposition from Governor Newsom and the California Chamber of Commerce.
A classic battle of a simple goal versus incredibly messy implementation.
Exactly.
All right, time to look to the future skies and that intense competition between Boeing and Airbus. For 2025, Boeing has finally surpassed Airbus in net new orders.
Yeah, 1,175 to 1,000. It's Boeing's first annual lead since 2018, and it's a huge milestone. It shows real improvement in their production, especially on the 737 MAX line.
But you have to add the context that revenue is tied to deliveries, not orders.
Crucial context. And Airbus still delivered significantly more planes, 793 versus Boeing's 600, so that immediate revenue gap is still there, and it's Airbus's current strength.
Still, some massive orders show that confidence in Boeing is returning. Delta, for instance, ordered 30 of the 787-10 Dreamliners.
And that's a very strategic buy. The 787-10 is the high-capacity, fuel-efficient one. It's optimized for those dense, long-haul routes, like across the Atlantic, to replace their aging fleets.
And maybe the biggest vote of confidence comes from Alaska Airlines. They placed their largest ever order, 110 planes.
And this is after that serious safety incident in January 2024 with the MAX 9 door plug.
Exactly. To place that order with MAX 10s in the mix after that incident, it just speaks volumes.
It really does. It's a bet on the manufacturer getting its house in order and a belief in their recovery efforts.
Speaking of the future, let's talk about some of the innovation frontiers. I mean, we're seeing designs that look like something out of a sci-fi movie.
You're talking about JetZero, the U.S. startup that just secured another $175 million in funding, bringing their total to over $1 billion.
And they're building the Z4 demonstrator, the world's first commercial all-wing airplane.
An all-wing aircraft. The efficiency gain is supposed to be staggering. They're aiming for 30 to 50% better aerodynamic efficiency than a traditional tube and wing design. First flight is targeted for 2027.
Incredible. And while JetZero is working on the wings, we're seeing the infrastructure for urban air mobility, UAM, get built out.
Absolutely. UrbanV in Italy and Pax Aeroportos in Brazil are partnering to develop vertiport networks at existing airports in São Paulo and Rio. This is the practical, boring, but necessary step of integrating EV tools into current operations. It's crucial.
And finally, a really niche but critical advance in power systems for UAVs.
Yeah, Hearth Engines and ePropelled are working on hybrid propulsion. They're integrating two-stroke engines with electric starter generators. The goal is better fuel efficiency and endurance for military and commercial drones that need to run on heavy fuels, like jet fuel. So if we pull all this together, what's the theme? I mean, to me, it's about setting boundaries.
In what way?
Well, whether it's the strict legal definition of decentralized in DAMSA or the for-cause mandate for a Fed governor, it's all about figuring out where government control ends and market freedom begins.
And you can see how the global economy accelerates when there's clarity on that. You get Japan's Sanonomics driving the Nikkei to 53,000, or a startup like JetZero getting $175 million because the vision for an all-wing aircraft is clear. Capital moves when the mandate is clear.
Which brings us to our final provocative thought for you to chew on. We saw the strong opposition to that 10% credit card cap with the argument that it would actually hurt working-class Americans by cutting off their access to credit.
And at the same time, we saw JPMorgan Chase take on billions in risk-weighted assets by buying the Apple Card portfolio, which shows just how vital consumer credit is to the big banks.
So, given that undeniable need for credit versus the risk of high debt and the fact that commercial banks are reluctant to serve the highest risk borrowers, what system is truly necessary to ensure high quality, non predatory financial access is available to everyone, regardless of their credit score? Is it time to make the expansion of those nonprofit CDFIs, which we mentioned as an alternative, a mandatory, subsidized national priority to fill that gap?
Something for you to think about until our next deep dive.